Assalamualaikum warahmatullahi wabarakatuh. Today, our group will present about the acquisition of DRB-HICOM BERHAD'S and PROTON Holding BERHAD'S. My name is UWAIS bin Ahmad GHADAFFI and I will start the presentation. The DRB-HICOM and PROTON deal was an acquisition, as DRB-HICOM acquired a substantial shareholdings in PROTON from Khazanah Nasional Berhad by purchasing 42.72% of PROTON shares under a conditional sale agreement. This acquisition implied that DRB-HICOM has become the majority owner of PROTON. Next, the main reason about acquisition. The acquisition occurred after Khazanah decided to sell its stakes in PROTON to a strategic investor. They chose DRB-HICOM due to three reasons. Firstly, financial and strategic support. DRB-HICOM was able to provide the financial resources and strategic business planning to strengthen PROTON's competitiveness and development. Second, privatization and efficiency. The disposal aligned with Khazanah's objective to increase private sector participation in the automotive industry. And lastly, automotive alliance and technology transfer. DRB-HICOM's local and international partnership allow PROTON to access new technologies, markets and expertise.
I will explain the liquidity position of DRB-HICOM and PROTON using the current ratio and quick ratio. First, DRB-HICOM has a current ratio of 0.73, indicate a weak short-term liquidity position since current liabilities are higher than current assets. DRB-HICOM face a cash flow difficulties. In contrast, PROTON has a current ratio of 1.7, which shows a strong short-term liquidity position. This means PROTON has enough current asset to meet its short-term obligation as they fall due, and it is less that PROTON to experience serious cash flow problems. Next, looking at the quick ratio, DRB-HICOM recorded a ratio 0.7. It indicates that DRB-HICOM does not have sufficient liquid asset to settle its short-term debts. PROTON quick ratio is above 1.0, which indicates a healthy immediate liquidity position. This shows that PROTON can pay its short-term liabilities using liquid asset alone without needing to sell inventories.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad bin BAHARUDDIN. So now I will explain the profitability ratio analysis of DRB-HICOM BERHAD and the PROTON before the merger. So the first one, for net profit margin, DRB-HICOM recorded a net profit margin of 8.38%. This showed that the company was able to generate reasonable profit from its sale, supported by good cost control and stable operation. However, PROTON only recorded a net profit margin of 1.73%. This indicates very thin profit margin and high operating costs relative to its revenue. Next, in terms of return on assets, DRB-HICOM achieved a ROA of 10.02%, showing that the company used its asset efficiently to generate profits. On the other hand, the ROA of PROTON was only 2.03%, which reflects poor asset utilization. This suggests that PROTON had a large asset base but was unable to generate sufficient return from those assets. Moving on to return on equity, DRB-HICOM recorded a ROE of 11.45%, indicating a strong return to shareholders and making the company financially attractive to investors. In contrast, the ROE of PROTON was only 2.88%, which shows a low return to shareholders and weak value creation for investors. In conclusion, before the merger, DRB-HICOM was financially stronger and more profitable while PROTON was underperforming. This difference in performance supports the strategic rationale for the acquisition and the need for restructuring after the merger.
Next, I will continue in leverage ratio. DRB-HICOM has a high debt to equity ratio of 3.90 times, reflecting heavy capital investment in car assembly, property and services, which naturally rely on higher leverage. In contrast, PROTON's low ratio of 0.42% shows a stronger equity base and lower financial risk after restructuring. Although DRB-HICOM maintains a healthy interest coverage of 9.99 times, PROTON stands out with superior profitability and stronger coverage with 17.05 times, indicating efficient operations and minimal debt burden. Overall, PROTON demonstrates better leverage management and greater resilience during economic uncertainty.
For the next ratio is a valuation ratio. For market valuation, we use the price to earnings ratio. Both the DRB-HICOM and PROTON have the same PE ratio of 7.78. This indicates that the market value both companies equally based on their earnings. Investors are willing to pay the same price for every ringgit of profit generated by both firms, targeting similar growth expectation and perceived risk. Therefore, from a market valuation perspective, neither company has a clear advantage over the other. Next, we look at the acquisition price using the EV over EBITDA ratio. The DRB-HICOM has a negative EV over EBITDA of minus 1.7, which means it appears very cheap to acquire. However, this also signals potential financial distress or low investor confidence, making it a higher risk acquisition. In contrast, Proton's EV over EBITDA of 7.8 falls within a healthy range, indicating stable operation and more predictable cash flow. Although Proton is more expensive to acquire, it represents a lower risk and more stable acquisition target.
Next, I will explain the impact of the acquisition on the group's liquidity of the combined liquidity position. Next, after the acquisition of Proton, the company faced higher short-term financial pressure. This is because current liabilities increased, especially trade payables and bank borrowings. Secondly, the acquisition has led to a higher inventory exposure. This situation is expected because Proton is involved in manufacturing and automotive activities. However, inventory in the automotive industry is not easy to convert into the cash quickly. Overall, the company's liquidity position has worsened after the acquisition. Both the current ratio and quick ratio are below acceptable levels. The automotive business requires large working capital and inventory, which reduce liquidity in the short term, although the acquisition may bring long-term strategic benefits to the DRB-HICOM.
Next, I will explain the operating margin and EBITDA margin to evaluate cost savings and efficiency improvements after the synergy. First, the operating margin is 10%, which means the company earns 10% of operating profit for every 1 ringgit of revenue. This indicates that the company has improved its cost control and operational efficiency after integration, mainly through reduced overlapping costs and better use of resources. Next, the EBITDA margin is 15%, which shows the company's ability to generate strong cash-based earnings from its core operation. Since the EBITDA margin is higher than the operating margin, it suggests that the synergy has positively improved operational performance and profitability. For overall, these margins confirm that cost savings and efficiency improvement have been successfully achieved post-synergy.
Next, I will continue on leverage and capital structure. Before the acquisition, the DRB-HICOM already had a high debt to equity ratio of 3.90%, showing strong dependence on debt financing, while Proton's much lower ratio of 0.42% reflected a healthier equity positions and lower financial risk. After the acquisition, the combined entities ratio increased further to 4.76%, indicating a significant rise in leverage and weaker capital structure stability. Although both companies initially show strong interest coverage, with the DRB-HICOM at 9.99 times and Proton at 17.05 times, this figure dropped sharply to 4.07 times post-acquisition. While interest payments are still manageable, the decline signals higher financial risk and reduced flexibility. Overall, the acquisition has placed a heavy short-term burden on the company, requiring careful debt and cash flow management going forward.
Next, earning per share ratio. In 2013, the DRB-HICOM experienced a significant financial transformation following the full acquisition of Proton. The basic earnings per share rose to 29.79 cents, supported by a net profit of RM575.3 million. This improvement indicates that the DRB-HICOM successfully enhanced shareholder value even after absorbing higher interest, debt, and restructuring costs.
Next, I will explain the ROIC analysis after the merger. After the merger, the DRB-HICOM recorded a ROIC of 8.83%, which is still positive. This shows that the company was able to generate return from both debt and equity after acquiring Proton. However, the ROIC is lower compared to the pre-merger ROA and ROE. This indicates that the high cost of the acquisition has not yet resulted in higher returns, although the invested capital increased significantly after the merger. The expected operational synergies and efficiency gains were not fully realized in the short term. Overall, the post-merger ROIC reflects moderate performance, suggesting that the acquisition requires more time to improve efficiency and create long-term value.
Next, I will explain the impact of the acquisition on the group's liquidity of the combined liquidity position. Next, after the acquisition of Proton, the company faced higher short-term financial pressure. This is because current liabilities increased, especially trade payables and bank borrowings. Secondly, the acquisition has led to a higher inventory exposure. This situation is expected because Proton is involved in manufacturing and automotive activities. However, inventory in the automotive industry is not easy to convert into the cash quickly. Overall, the company's liquidity position has worsened after the acquisition. Both the current ratio and quick ratio are below acceptable levels. The automotive business requires large working capital and inventory, which reduce liquidity in the short term, although the acquisition may bring long-term strategic benefits to the DRB-HICOM.